And so if somebody doesn't understand the difference and they're looking at the two, then obviously it's going to make a lot more sense temporarily to look at an accidental death and dismemberment policy or feel properly covered or insured. The AD&D is what the insurance is called. If we actually just read the very basic definition of what accidental death and dismemberment insurance is, it says accidental death and dismemberment insurance is usually a rider to a health insurance or life insurance policy. The rider covers the unintentional death or dismemberment of the insured, because tons of people die intentionally. I think that's so funny. Accidental death. Anyway, it covers the unintentional death or dismemberment of the insured. Dismemberment includes the loss or loss of use of body parts or functions such as limbs, speech, eyesight, and hearing. So, accidental death and dismemberment, or AD&D, coverage is fairly inexpensive. It's because it's covering specific types of death, not all types of death. And so specific types of death, such as a car accident. If I get in a car accident, an accidental death and dismemberment policy would cover that because it was an accident, obviously. But then there's certain exclusions, certain things that count, certain things that don't count in an accidental death and dismemberment policy. Also, there's going to be sometimes certain conditions in the policy in order to file a claim where it's not just that if you lose a limb, it pays out no matter what. It's how far up your arm you lose the limb, how far up your leg, how bad the accident is. And so having an accidental death and dismemberment policy, there's definitely nothing bad about it. There's lots of arguments whether it's a valid type of insurance or not. But if I'm on a job of some kind that there's a potential risk for that, certain things that maybe a traditional health plan wouldn't cover, it could be something that could be very, very valuable to have. But then the thing that's kind of interesting about it, though, is when compared to life insurance, what happens sometimes is people maybe through work or through the credit union or through whatever have an accidental death and dismemberment policy, and it's kind of sold as life insurance coverage that, hey, and if you die, because you think about it, it said the unintentional death. Well, how many people die on purpose? And so they look at that and say, accidental death, well, unless I kill myself, that's on purpose, right? Then this accidental death and dismemberment policy will cover me. And so you look at a $250,000 accidental death and dismemberment policy versus a $250,000 life insurance policy. This one is going to be less, and this one is going to be more as far as the premium is concerned. How much we actually pay for it. And so if somebody doesn't understand the difference and they're looking at the two, then obviously it's going to make a lot more sense temporarily with the information that they have, be it limited, to look at an accidental death and dismemberment policy or feel properly covered or insured by having an accidental death and dismemberment policy, where a life insurance policy is going to cover them for any reason that they die. Of course, there's the suicide clause for the first 2 years, that if they do commit suicide in the first 2 years, that the insurance policy has provisions in it that it would not pay a benefit. And so speaking of a benefit, and this is almost a review of some other lessons as well, is that the benefit in a life insurance policy or a standalone life policy, it's not a hybrid policy, just a straight life insurance policy, has a death benefit only. There's no living benefit. There's no accidental type of benefit. There's just the death benefit, right? Where an accidental death and dismemberment is money that can be used for the accidental death or dismemberment, and it becomes just a benefit, not a death benefit only, but a benefit, okay? So, similarly, to almost compete with this, as it said in the basic definition, an accidental death and dismemberment policy or rider could be added to a life insurance policy. A life insurance rider I've never seen added as a rider to an accidental death and dismemberment policy. Don't think that that can even be done, but it can be added as a rider. So, keeping with the basics of insurance, what is a rider? A rider is, well, as it was explained in the study material for the insurance license, a rider, you just imagine a horse, and you've got a horse with a rider on it, and so the horse can run and do well by itself, but then with, a rider is just something that sits on top of the horse, right? And so that's what a rider is, and there's lots of different riders that can be added to different policies, sometimes to make it less expensive. Almost like the way that I look at riders is you have, people that, it's 2018 right now, well, for a couple more weeks, and there are still people that have a flip phone and a digital camera, or they have a flip phone, a digital camera, and a Franklin planner. And so there's nothing, wrong with doing that, except you're carrying around a backpack or a purse to have all that stuff in it, where a lot of people just have a smartphone today, right? And so a smartphone is like a hybrid of those three products, and so you can have a hybrid type product where it's life and accidental death and dismemberment. If that's, a worry, where let's say that the base policy by itself, premium-wise, is going to be $35 a month. The standalone accidental death and dismemberment policy is $7 a month if we do those separately, but then to add an accidental death and dismemberment rider is only $2, let's say. And so by creating a hybrid instead of having two standalone, which you'll see as we talk about other insurances and combining them, what that can do is it sometimes saves money. And so to have a smartphone versus paying for the new pages to fill my Franklin planner, new pens all the time, losing it, that would cost a lot of money. I can just create a hybrid product and store everything on the cloud, right? So sometimes that can save me money, but what it does is it gives me additional benefits. And so those riders that are added to the policy, those jockeys or whoever getting added on top of a horse, is kind of a funny visual, adding a whole bunch of riders, right? Can potentially save me money as the insured. And so let's talk about, to round out this class, some of the different riders that can be added to policies, whether it's a health insurance policy, life insurance policy, what riders can be added. And so one we already identified, a rider that can be added to a policy is going to be an accidental death and dismemberment rider can be added. We can add disability insurance riders, and you can have a standalone disability policy, or you can add it as a rider. Okay, we talked about accidental death and dismemberment. What is a disability insurance? How does it work? So let's just use a real example. I have a client who is about 50 years old, has a PhD in psychology, and he is kind of has almost a dual career. He is a psychologist, and he has the cool couch and everything, and talks to people about their issues and problems and whatever, helps them overcome that. But he also is a coach, has coaching programs not only for people that are potential clients, but also for other psychologists that want to use his material. So looking into a disability policy, standalone policy, what it does is he pays a monthly premium, and I'm going to be using words, if you haven't watched the basics of insurance. I think it was lesson 25 or 24. I don't remember. You could jump back to just a few lessons ago. that he pays a monthly premium to basically cover the risk that if he were to become disabled and not able to work, that the disability policy would kick in and replace a certain amount of his income for a certain amount of time. And so what you can specify in a disability policy is what that monthly income is that you want it to replace and for how long. And obviously, if you think about it from the insurer's point of view, the more money they potentially have to shell out, the more they're going to charge in a premium from multiple people so that they're receiving enough in premiums to back what they're going to pay out in benefits. So, for example, he wants to replace $8,000 per month of income if he were to become disabled. And so by paying, and he would want that to last 5 years. And so if he wanted to last 10 years or 15 years or whatever, then it's obviously going to be a little bit more. And so he pays a certain amount every month, and then if he becomes disabled, they flip roles. He pays in nothing, and the company now starts paying him that benefit because he is disabled. And then there are certain things that would trigger whether someone's disabled or not. Not all the people that are on disability through the government that hurt their knee 10 years ago and limp every once in a while and go to the doctor and say that it hurts so they can just collect money from the government. That's not what we're talking about. Okay, this is the actual disability policy that they're paying for. Okay, that's what disability is. Okay, another one that can be added to it, another rider is going to be a long-term care rider, and we'll talk about long-term care insurance in a future lesson, but long-term care basically meaning if triggered by what are called the activities of daily living, or ADLs, if someone cannot do 2 of the 6 activities of daily living, it triggers the long-term care rider that then they could add to a policy that then turns the benefit. Let's just give an example. If I added a long-term care rider to my policy up here, so here's my policy right now, $35 in life insurance, $2 in accidental death and dismemberment, and then I add a long-term care rider to this policy, it doesn't change this number as far as up or down, and then let's say I pay an additional $12 for my long-term care rider. What that's going to do is that is going to make it so that this now has a dual benefit, where if I, or a triple benefit, but on the long-term care rider side is it turns this into money that I can use if I was needing long-term care, maybe in-home care if the policy has provisions that says I can use it for in-home care, or a long-term care facility. And how that usually works in a long-term care rider is it gives me a percentage that I can use per month of the benefit for a certain amount of time. So in most cases, a long-term care rider would look something like this. It's a $250,000 benefit if you die. So if I die, it turns into a life insurance policy. If it's a hybrid, as a rider, the long-term care as a rider on a life policy. I die, it's $250,000 tax-free to my family. Then, let's say I get to age 80, and I've got this life policy that I've been paying for with the long-term care rider. I'm paying $12 a month additional for, and I go into long-term care, or I need that in-home care. I can use, say, 2%, which is what most people end up doing, 2% of the benefit per month for 5 years, or until that runs out, or whatever the provisions are. So 2% of $250,000, that's going to be about $5,000. So I would get $5,000 per month, between $4,000 and $5,000 per month as a long-term care payment, and as long as it's a long-term care rider, which would require a health license, a health insurance license to add to a life policy, that's also tax-free income to the person that's collecting that long-term care benefit. Okay, so that's how that one would work. So then you also have, and I think we need to move our camera down to see these. So you have chronic illness, you have critical illness riders that can be added. You can add waiver of premium riders, and obviously chronic illnesses are certain illnesses that it would cover if you were diagnosed with that. There's the critical illness, which are a whole another set of conditions and diseases and whatever that can be added. And then waiver of premium riders, obviously if you qualify for certain provisions, they waive the premium, that you don't have to pay the premium anymore. One that is actually, and we'll finish with this one that's almost free with every policy is going to be something called a terminal illness rider. Okay, so a terminal illness rider, and we're not going to use the board anymore, but a terminal illness rider is going to be one where, let's say that this is my policy again. I've got a $250,000 policy. I have the terminal illness rider on it because it's free. It just comes with the policy. And I go to the doctor today because my chest is hurting a little bit, and come to find out that I've got lymphoma, and it's really serious, stage 4. They do some scans, and I get a note from my doctor. I get a letter that goes into my medical records that says Adam is going to die in the next 12 months. You know how advanced it is. The diagnosis, is he doesn't have 12 months. So after I cry a little bit, my family cries. I can send in a letter. I can send in that letter from the doctor to the insurance company. They do a little bit of underwriting of it and checking the situation, call doctors, whatever. But now, because of that terminal illness rider, I can actually start using this benefit while I'm alive. Not all of it, but portions of it to pay bills. To a lot of the time, people will go on vacations with families to, create some family experiences before their loved one passes away. But it's also something they might have to be a little bit careful with because let's say they are cured. So they don't want to drain all their life insurance to go have fun and then be cured from cancer because now they don't qualify for life insurance anymore. And it's not like they can just go refill it after spending it. Okay? So that's what a terminal illness rider is. So thank you again this morning for joining us on the Impact School of Money. Today, conversation was the difference between accidental death and dismemberment, life insurance, and the different riders that can be added to each of it.